Folks, today we will be discussing the One Big Beautiful Bill Act, often referred to as the OBBBA, and the key tax law changes within it that every individual should be aware of. Before we dive right into the details, here are a few quick facts about the OBBBA. The bill spans somewhere between 870 and 1,116 pages, depending on the source or version. So yes, it's quite comprehensive. It passed the House on May 22nd, the Senate on July 1st, and it was signed into law on July 4th, 2025. This legislation includes $3.8 to $5 trillion in tax cuts and spending changes, with offsets largely coming from healthcare and entitlement adjustments. And the bill touches a wide range of areas, including border security and immigration, defense and energy production, changes to SNAP and Medicaid, and broad federal spending reforms. But today, we're going to focus solely on the tax policy side of things, and more specifically, on individual tax provisions. Let's jump in. The tax rates that were temporarily enacted in 2017 under the Tax Cuts and Jobs Act have now been made permanent. These rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. For comparison, the pre-Tax Cuts and Jobs Act tax rates were 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. So slightly higher across the board, with the exception of the initial 10% bracket, which remained the same. Importantly, these brackets will be adjusted for inflation starting in 2026. This means that income thresholds for each bracket will gradually rise over time to account for inflation. Okay, the increased standard deduction. If you are single, your standard deduction will increase from $14,600 to $15,750. And if you're married, your standard deduction will increase from $29,200 to $31,500. If you're age 65 or older, you'll also get an additional standard deduction amount. If you're single, that amount changed from $1,950 to $2,000. And if you're married, that amount increased per spouse that's eligible from $1,550 to $1,600. So this essentially means that more income will be sheltered from federal income tax, and seniors will benefit from a slightly larger bump. The higher standard deductions may reduce the need for itemizing for many households, that is, adding up charitable contributions, medical expenses, property taxes, etc. And it's important to note that these amounts will be adjusted for inflation beginning in 2026. All right. So this is a brand new temporary deduction, a bonus senior deduction, available to taxpayers age 65 or older at the end of the tax year. The deduction is worth $6,000 if you're single, or if you're married and only one spouse qualifies, and $12,000 if both spouses qualify. However, there is an income phase out. Single taxpayers must have an adjusted gross income below 75 grand to receive the full bonus deduction, and below 175 grand to receive a partial deduction. While married taxpayers must have an adjusted gross income under 150 grand to receive the full $12,000 deduction, and under 250 grand to qualify for a partial deduction. An important tax planning tip here: monitor your income levels to stay within the eligibility limits. Some income sources, like Social Security income or pension income, are fixed, but others are within your control. For example, monitor capital gains in brokerage accounts or distributions taken from your IRAs, because these income sources can push you over the threshold. These bonus deduction amounts will be adjusted for inflation starting in 2026. Okay, the child tax credit has been increased from $2,000 to $2,200 per qualifying child. Eligibility requirements are: the child must be under the age of 17, have a Social Security number, and must be claimed as a dependent. And at least one parent must have a valid Social Security number as well. The credit is reduced by $50 for every $1,000 or partial $1,000 of modified adjusted gross income above the threshold of $200,000 for single filers and $400,000 for married filers. Okay. The lifetime estate and gift tax exemption increased to $13.99 million in 2025, up from $13.61 million in 2024. So for married couples, this effectively allows them to shield up to $27.98 million from tax, both during their lifetimes and at death. Additionally, the unused exemption remains portable to surviving spouses through the portability election. This enables any unused portion of one spouse's exemption to be transferred to the other upon their passing. Looking ahead, the exemption will rise further to $15 million in 2026, with annual inflation adjustments thereafter. This change eliminates the risk of a steep decline in the exemption after 2025, providing greater clarity and predictability for estate planning. Also, the annual gift tax exclusion increased to $19,000 in 2025, allowing individuals to gift up to this amount per recipient each year without incurring gift taxes or reducing their lifetime exemption. So gifts made of $19,000 or less to any individual during the tax year will not chip away at their lifetime exemption. Together, these provisions offer enhanced flexibility and certainty for high net worth individuals and their families as they navigate their wealth transfer strategies. Okay, the increased SALT deduction cap. SALT stands for state and local taxes. It's your state and local income taxes, your state and local real estate taxes, and your state and local property taxes, like your ad valorem taxes paid towards your vehicle. The SALT deduction has recently been capped at $10,000, but now the cap will be increased to $40,000. However, income limitations will apply. The SALT deduction shrinks by 30 cents for every dollar that your income exceeds $500,000. And when your income reaches $600,000, only a $10,000 deduction is allowed. The SALT deduction is set to revert to a $10,000 maximum in 2030. This is temporary. Okay. Car loan interest deduction. This is brand new. So deduction paid, there's a deduction allowed for interest paid towards your car loan, a $10,000 maximum deduction. There's key requirements in order to be eligible. Your vehicle must be a car, minivan, van, SUV, pickup truck, or motorcycle weighing less than 14,000 pounds. Assembly must have taken place in the United States. The loan must have been entered into after 12/31/2024. And the vehicle must be used for personal purposes, not for business or commercial use. This deduction applies only to loans used to purchase the vehicle. Lease payments do not qualify. The deduction is reduced by $200 for every $1,000 of modified adjusted gross income above $100,000 for single filers or $200,000 for married filers. And a quick example, a Ford F-150 assembled in Dearborn, Michigan, and a Honda Accord assembled in Marysville, Ohio, both qualify. Of course, Ford is an American-based company and Honda is a Japanese-based company, but all that matters is that final assembly took place in the United States. That's what's key. Okay. Trump accounts for children. So who qualifies? U.S. citizens born between 2025 and 2028 with a valid Social Security number will qualify. Children will automatically receive a one-time deposit of $1,000. That's known as federal seed money. Each year thereafter, parents can contribute $5,000 and parents' employers can contribute $2,500 max. Withdrawals, under age 18 withdrawals are not allowed between ages of 18 and 24. You're allowed to access up to 50% of the account for education a first-time home purchase, or to start a business. Between the ages of 25 to 29, you can access up to 100% of the account for education, a first-time home purchase, or to start a business. And after age 30, withdrawals are allowed for any purpose. A few important notes here. Investments must consist of low-cost mutual funds or exchange-traded funds and meet other certain criteria. The $2,500 max contribution limit for parents' employers counts towards the overall $5,000 max contribution limit for parents. It's not in addition to. And growth in this account is only tax deferred. Qualified withdrawals are taxed at long-term capital gains rates, whereas non-qualified withdrawals are taxed at ordinary income rates, plus penalties if the child is under 18. 529 plans can now be used for more than just tuition for kids in kindergarten through 12th grade. They can now be used for curriculum materials, textbooks, digital and online education tools, tutoring, standardized test prep fees, and educational therapies. This broader expense eligibility takes effect for distributions made after July 4th, 2025. And also, the annual distribution limit increased from $10,000 to $20,000 per student. This change takes effect in tax year 2026. All right, so historically, it's been necessary for taxpayers to itemize their deductions in order to benefit from their charitable contributions on their taxes. But now, taxpayers claiming the standard deduction can deduct a modest level of charitable contributions as well. That amount is $1,000 if you're single or $2,000 if you're married. This deduction is especially useful for moderate donors taking the standard deduction. This deduction does not take effect until 2026, and it's not currently indexed for inflation. All right, so this has certainly been a crash course and a high-level overview of the key tax changes enacted by the OBBBA. There are many important topics that we didn't cover today: no tax on tips, no tax on overtime, changes to the piece limitation, changes to the qualified business income deduction, and more. If there are topics that we didn't discuss that you have questions about, or if you'd like more details on how these changes might affect your personal situation, please do not hesitate to contact us. We're happy to help, and we're always an email or phone call away. Thanks for watching.
Hello, I'm Daniel McNabb, the investment team lead here at Chicory Wealth. And today we're going to be going over the One Big Beautiful Bill Act that was recently passed into law. We'll be discussing some of the economic and investment implications of the bill and contrasting those views with the views of the Congressional Budget Office and more broadly, the political discourse currently occurring. So we'll start with highlights of the various centers of impact. We'll cover consumer demand, labor supply, productivity, and innovation. So we'll start with the overall economic impact, which is important because this is one of the main bullet points that the Congressional Budget Office has put out there. They say that GDP will be positively impacted by almost 1% annually, which a percentage which will lessen and trail off to 2034. This is an important note because we know that the bill increases the deficit by an estimated $3.4 to $3.5 trillion over 10 years, which is $350 billion a year. Now, US GDP is about $30 trillion a year. And so if you expect GDP to be increased by 0.9%, that's $270 billion a year, which would an impact which would trail off, but still that takes a big chunk out of that deficit. One of the common arguments made is that if we increase GDP, then we can actually increase our deficit as long as we increase those in tandem. However, the GDP growth number is heavily disputed, and we believe could certainly be grossly overestimated. And there are a number of reasons for our concern here. So first, consumer demand, which is a very large part of GDP. The CBO, Congressional Budget Office, says that higher aggregate demand will be associated with higher GDP. So they say we're going to cut taxes, we're going to fuel spending through various incentives, and that will lead to more money in people's pockets, which they will spend in the economy, and that will fuel GDP growth. They think that the Medicaid cuts and SNAP cuts, which institute work requirements, will that money will flow back through into the economy because people have more money to spend. Specifically, higher earners will have more money to spend. And so we believe that this is likely not to occur, this increase in spending. The tax cuts are not really tax cuts. They're more just a continuation of existing tax policy with some changes to how 1099 income is taxed, how wages are taxed with people who receive tips, and some Social Security tax changes. So we think that impact is likely grossly overestimated, and we believe that inflation could also end up taking a bite out of people's pocketbooks, and so we think that consumer demand increase from the bill might be much lower than they anticipate. Labor supply. So the bill says the CBO believes that the bill will increase labor supply. They believe that will occur in part because the incentives to work because of lower tax rates will cause more people to enter the workforce. We do not believe that is how people make their decisions. We don't think that is likely how this will play out. They also see a small increase in labor supply because of the new work requirements for Medicaid and SNAP benefits. We also disagree and do not think that a large number of people are going to be re-entering the labor force because their benefits are going away. We think it more likely that those people will just continue to will end up in a situation where they just do not have those benefits, which could be disastrous to say the least. So what happens when labor supply does not increase as much as the CBO says? Well, we could have labor shortages, which could increase costs for small businesses and large enterprises. It could drive up costs for agricultural products. It could have negative implications for inflation as a whole. And one of the main things that we see happening is the cessation of immigration from the southern border, which until now has been a very large supply of labor for our economy. Immigrants have always contributed to our economy in a very important way, and with the cessation of that immigration, we expect to see labor shortages begin to develop in the coming years. We also see deportations potentially playing a role as the ICE budget was increased by this bill. It was basically quadrupled. And that we have seen in the numbers that they are arresting more people, the majority of which have not been charged with any crime. And if this continues or becomes even more intense, we could see that also having a large impact on labor supply. So these are all important issues that the CBO has kind of just shrugged off. Productivity and innovation, we have some concerns here as well. CBO estimates a slight net positive impact on productivity and innovation. So they believe that the temporary expedited depreciation rules will increase private investment in new capital assets. So things like machinery, and because they can expense those, they can deduct those expenses much faster, which is good for their profits in the short term. So we may see some impact from that. Hopefully, some of those investments are being made in greener industries that are less carbon intensive. But we are likely to see lots of those investments happening in the oil and gas industry. We're hopeful that we'll see some nuclear energy as well. We predict that there could certainly be a negative impact on innovation as a result from the immigration policy and the endowment tax, which will squeeze the budgets of many of the institutions that provide very important research and development functions, specifically in the STEM areas, which we believe are the most important areas to continue development, sustainable development on our planet. And so many people have described this as a war on science, and we tend to agree that there are really important projects that are likely to be cut because of the endowment tax. So we think that the productivity and innovation could take a hit from this bill. So overall, what is the investment impact? Now, of course, this is a little bit more nebulous than, say, the tax implications, where we kind of know the rules and we know how those rules are going to be enforced. The investment impact is going to be, again, more nebulous, where we have these broad macroeconomic factors that are being influenced by the various components of this bill, which they are many. And so on the whole, we believe that inflation will continue to trend higher than the Fed's 2% target. We believe it could trend higher than the CBO's estimates, which do project an increase in 2026. And so inflation continues to be one of the most important risks that we are focusing on in your portfolios. So there are inflation-protected treasuries in the bond portion, continued equity exposure, stock exposure, which is normally quite a good hedge against inflation. These are some of the key steps that we're taking to protect your buying power. So when higher inflation is present, that often also is reflected in higher interest rates. So in the bond portion of your portfolio, if interest rates remain high or go higher, what that means is the value of the bonds that are at lower interest rates will decline. And that decline is seen more starkly the further out the maturity of that bond is. And so we will continue to stay slightly more conservative on the bond side, with duration, a maturity average around 4.5 to 5 years versus our benchmark index, which is about 6 to 6.5 years. So we're a little bit more conservative there, projecting that interest rates could remain elevated. And then labor-related risks, the risk that companies have difficulty finding and retaining labor. So we believe that the companies who are treating their employees the best, and that have robust training programs, have equitable hiring processes, have diversity within their workforce, generally creating a work environment that people want to be in will do the best job at retaining employees and mitigating labor-related risks. So we will continue to assess companies based on that critical metric. And then research and development. So we believe that companies that are innovating are going to continue to outperform. So we'll be focusing on companies that are providing solutions to some of the world's greatest problems. Innovation occurs in many different spheres, and our hope is that even as it perhaps is forced to pull back in certain areas, that certain other areas will step up and will help fill that gap. And so we will continue to invest in companies that are innovating in sustainable solutions to the world's problems. So that is the highlight of our view on the One Big Beautiful Bill Act. If you have any questions, please feel free to reach out to your advisor, or you can also email me, Daniel McNabb at chicorywealth.com. Thank you.